Welcome students. Today's topic is capital structure and sources of finance. This is one of the key important topic of the finance. So in this topic, I'm going to cover what is capital structure and what is the formula of the capital structure. Then sources of finance. What is the sources of finance? And at the last, importance and factor of capital structure. Okay. So to begin with, what is capital structure? So capital structure refers to the mix of proportion of different sources of long-term finance. Okay. It is a kind of mixture, or I would say mix of or blending of different sources of long-term funds used by a company, a firm to finance its operations and growth. All right. It mainly includes owners fund. So if you're talking about owners fund, that means equity share capital, preference share capital, retained earning, and reserves as well. Apart from that, borrowed funds. So borrowed funds included debentures, long-term loans, and bank loans. All right. So the capital structure is expressed as the ratio of debt to equity or the proportion of debt in total capital. Okay. So if you are talking about the formula of capital structure is equal to debt upon debt plus equity. So in short, it is known as debt to equity ratio. Okay. So the formula is debt divided by debt plus equity. So the mix is important because each sources has different cost and risk, right? So that's the reason the combination, the mixture is very much important if you are talking about the sources of finance or capital structure. Moving to the next, that is sources of finance. Okay, so here I have bifurcated in two segments. One is owners fund, another one is borrowed funds. Under the owners fund or equity capital, first one is equity share capital, second one is preference share capital, third one is retained earning, and fourth, reserves and surplus. I'll go one by one. So if you're talking about equity share capitals, that is money from shareholders owning the company. Preference share capital is shareholders with fixed dividends. Retained earning, that means the profit reinvested back into the business. And reserve and surplus, that is the internal funds available for the expansion, or maybe we can say to mitigate the future risk as well. All right. Talking about the borrowed capital or borrowed funds or debt capital. So, one is debentures, another one is bank loan, then financial institutions loan, and public deposits and lease finance. I'll go one by one. So, long-term debt instruments is in debentures. Talking about the bank loan, it is the loan from the bank for business needs or maybe business expansion. Financial institutions loan, that is the loans from institutions like LIC, IDBI, or any other institutions. Public deposits and lease finance, it could be other debt forms. Okay, so that comes under borrowed capital. So sources of finance, one is equity capital, another one is borrowed capital. All right, moving to the next, that is importance and factors of capital structure. Okay, so importance, if you are talking about the capital structure is concerned, a well-planned capital structure balance risk and returns both, because each and every sources of funds having cost attached to it and risk as well. So it is well-planned capital structure, balanced risk and returns. It helps minimizing the overall cost of capital by blending or mixing of different sources of finance. Then impact and profitability, liquidity, and financial risk of the firms, right? And another one is, and ideal debt to equity ratio is often considered 2:1, but it depends on firms' specific factors. Okay, so this is the importance of the capital structure. Even though debt to equity ratio, that is the ideal one, is 2:1. However, it depends upon the specific factor of the firms or the company. Now, talking about the factors affecting capital structures, I have jotted down couple of the points. So first one is cost of different sources of funds. Definitely, if you are talking about debt, if you are talking about equity, so their cost is different. So cost of different sources of funds definitely affect the capital structure. Okay. Another one is financial risk and risk of earning variations, right? So definitely, as far as the capital structure of sources of finance is concerned, each and every source having their risk and also the earning variance. Okay, so financial risk and risk of earning variations. Next one is nature and size of the business. Definitely, it depends upon size of the business and also which type of this business is. Next one is flexibility in raising funds. Okay, so if we are talking about the new firm, new company, and it is there is no as such any previous trend and all, so it would be a bit difficult to have the shares will be subscribed in the market. So they are looking for the other options as well, right? So here I'm just giving in one example, but yeah, it also depends upon the flexibility in raising the funds. Okay. Another one is market conditions and companies growth prospect. Yes, definitely. If market is kind of having the interest rate is high or something like that, in that situation they will think upon whether they can go for the long term borrowings, like debentures or maybe the public debts as well. Okay, depends upon, and also how the future prospect of the company, so accordingly they can plan the capital structure. All right, so that's it for today's topic. I hope you understood it. Keep practicing at your side. Do let me know if you have any questions. Please visit my Urban Pro profile. Thank you.